What's up everyone, it's Karthik with MoneyVest. Welcome on board for our market open live stream on this fine Thursday morning as we are seeing things moving a little bit here. So we got QQQ slightly down about 14 basis points. S&P 500 is also flat as Tesla continues to break down. It's down almost 1% pre-market. Nvidia is slightly up over 33 basis points. And then we've got Oscar Health pushing higher as an ACA deal seems to be a bit more close. It is pushing up over 6.8, almost 7% at the moment as well. Pre-market getting back up to over $17, almost $18 per share. And HIMS is slightly down, close to 1% as Ethereum and Bitcoin once again are indeed selling off. Bitcoin back under $90,000 and Ethereum is trading at under $3,100 as well. So we're seeing a little bit of a pullback from that resistance in crypto, and volatility is once again pushing up over 2%, getting back to almost 16 right now in this pre-market at the moment. So if my audio and video is good, just give me a thumbs up. I just want to make sure that everything is working well. So again, just give me a thumbs up and we should be all set and all ready to go here. Don't forget, very important unemployment numbers coming out tomorrow at 8:30 a.m. Eastern, bright and early because it is the second Friday of the month of January, but it is going to be for the month of December, rounding out the entire year of 2025. And the consensus has indeed moved up to 55,000 jobs added in the month of December, with unemployment rate expected at 4.6%. And manufacturing expected to continue to see that decline of 10,000 jobs in the month of December. So that's where we are for unemployment numbers. Joel's numbers came out yesterday, coming in at 7.15 million, a substantial drop versus where the expectations were. And tomorrow, I think it's going to be essentially a done deal whether we're going to see a rate cut or not. As of right now, the markets are very much pricing in for a rate pause, about over an 80% probability that we're going to see a rate pause in this meeting in the next 20 days when the Federal Reserve meets again for the FOMC. So now a 90% chance that we're going to see a rate pause. So good morning, everybody. Good morning. Good morning. Thank you so much for joining, everyone. Iron levels to watch to add. My cost basis $44. We'll take a look at iron as well and do a quick technical analysis here as it continues to break down and selling off from its highs of $49.30. Next support is going to be $39.50 to $39 for iron. I think that would be a pretty decent level to look into for potentially adding into that stock. So if you are looking at dollar cost averaging, that would be the price point I would be watching for iron at around $39.50 to $39 for this stock. So let's take a look at APLD. Earnings came out very good. Is it a good time to buy? Let's take a quick look at their earnings. Looks like an earnings beat, however, still reporting for essentially no profitability. Revenues coming in very, very strong with over a 48% beat at over $126 million of revenue versus EPS of 85 million. And this is going to turn into a support. It was consolidating sideways, or it still is in this symmetrical triangle, and pre-market pushing up almost 6% at the moment. So let's just quickly look into their actual numbers. So jumping 5%, AI data center demand is the main driver. Securing a multi-year lease agreement worth billions, including a recent $5 billion deal with a US hyperscaler for 200 megawatts at its Polaris Forge 2 campus in North Dakota. And the management also announced plans to spin off its cloud service businesses. And reading further, second quarter earnings, Applied Digital broadly topped estimates and said late Wednesday that it was in advanced talks with an investment-grade hyperscaler or large cloud provider for a total of 900 megawatts for power across 3 sites. So if you take a look at the valuation for the company, $8 billion is what we're looking at in terms of the market cap, with 2025, this is for a quarter ending in November, coming in at about $126 million, right? So if you look at the quarterly numbers, we're looking at 126 million, obviously getting significantly better on a quarter-over-quarter basis, as well as profitability. Margins are improving. But if you take a look at the trailing 12 months of revenue, of 53 million, another 38. We're looking at about 90, 154, and then another 126. We're looking at about $275 million of revenue. So that is the actual revenue number for the last 12 months or last 4 quarters for the business. And the market cap right now is sitting at about 8.2 billion, right? So 8260 divided by 275, we're looking at a 30 times sales for a company on a trailing 12-month basis. So that is a pretty substantial number, right? So price to sales ratio, 29.8, almost 30 times sales. Now, even if you do expect for the revenues to, let's say, double in the next 12 months. So if you come over to expectations here on an annual basis, and we're looking at 2026 at 552 million. So that is a double in revenue. That still puts the company's valuation at around 15 to 16 times sales, right? So it's essentially going to be cut in half. So 8260 divided by 552, we're looking at about 14.9. So just a little bit shy of 15 times sales with no profitability expected even in 2026. So for me, when you're looking at companies, it can be a small position, it can be a starting position, but if you are going to be allocating a substantial part of your portfolio into a stock that is not profitable and also trading at a 15 to 30 times sales multiple, you better be sure about their execution. You better be sure about their long-term profitability, their path to profitability, and what that forecast looks like. So for me, APLD becomes a great tradable stock. It becomes more of a stock that I can, swing trade or I can trade options on. But from a long-term perspective, we have to evaluate the fundamentals. We have to evaluate the data and the numbers themselves, and everything is in front of you, right? So about $250 million of revenue over the last 12 months or last 4 quarters, 30 times sales, forecasting for the next year, even if they double revenue, which they are expected to do from about 310 million for this entire year to 552 million, that is still putting us at 15 times sales. And if you're comfortable with that, then by all means, it makes a lot of sense, even at these prices. At around $20, which would be a discount from these levels of about 30%, I think maybe it starts to make more sense. 8260 multiplied by 70%, we're looking at a $5.8 billion market cap, divided by 552 million of revenue, 10.5 times sales. Not bad. So maybe that's a level where we can start to consider APLD. So again, fundamentals, very, very important. That should always be the foundation for, looking into companies from a long-term perspective. And it's really not that hard. We have to just evaluate the valuation multiples and where those companies are trading at. That's really what it is. You look at the revenue, look at the earnings, look at the margins, and what is the market cap for the business. And then just run your analysis to better understand what the valuation looks like. Okay, so APLD, that was a little bit of a longer answer, but let's take a look at a few different businesses. Can you please share your thoughts on CPRT? I believe that is Copart, if I'm not mistaken. I think I like this company. I think the stock price was very, very strong up until it wasn't. So if you come take a look at the monthly time frame, this still feels a little bit of a blip on a monthly time frame because it's been absolutely incredible since 1996, 57,000% increase. I think it's a company that provides remarketing online auctions for vehicles, sellers a full range of services to process and sell vehicles primarily over the internet, virtual bidding, so on and so forth. So yes, it's been incredibly profitable with over 35, 34, 33% margins, very, very consistent as well. So on an annual basis, you can see the revenue is absolutely exploding, margins getting better, but on a quarterly basis, you can start to see that it is kind of plateauing a little bit. So if you come over to statements, income statement, and if you remove for everything else other than revenue and profit, you can see that it's been rather stable and still very profitable, but also stable. So not a lot of growth is being priced in. You can see that it's kind of moderating a little bit. So $1.40, $1.59, $1.64, $1.77, $1.87 is the earnings forecast. So it's not a growth company per se. It is it's not a high growth company. It is still considered as a growth business because revenue is 4.7 to 4.9 to 5.2. So yes, there is some linear growth, but it is a slow growth stock at the moment. And valuations, 24 times earnings, 8 times sales. I think it's now come down to some pretty attractive levels after the sell-off. From its highs of $64, it's almost cut in half. So it's down over 39%. So yes, I mean, if you consider where it was trading back when it was at $64, $65, you're looking at a stock that is growing earnings by 4 to 5%, trading at over 50 times earnings. Does not make any sense, right? 10 times PEG ratio is insane. It's insanely overvalued. So with this repricing of 40%, you've got a stock that's trading at 28, 29 times earnings. I would argue, or 24, not 20, 29, but 23, 24. I would argue still a little bit up there, given the expectations for earnings and 8 times sales and 20 times cash flow. So if I were looking into this stock, I would be looking at a support and a price around $25, which would require for the stock to come down even more, I think another 30% or so, at $25, $26. So that's the level that I would be watching for Copart. Okay, yesterday we looked at a few stocks related to storage. Can you look at WDC technical analysis, please? Western Digital Corporation, absolutely insane. Looking at this monthly time frame, it's just gone crazy from this huge breakout that we're witnessing at the moment, and from its lows from back in April of last year, 600%. Wild. I mean, valuations have just gone through the roof for some of these businesses, right? I mean, it's gone up 6, 7 times. It's gone up in value, which is crazy to think about. So, yeah, I mean, very, very overbought. I mean, on a monthly time frame, you've got an RSI at over 90. On a weekly time frame, you've got it over 80, and daily time frame, you've got 61. But I would be extremely careful with this stock here at these levels because of how overbought this is from a technical perspective, right? So if there is any kind of profit taking or any kind of selling pressure, I mean, if it breaks below this trend line, I'd be watching a support at 133. But that's the problem with stocks that go up so fast that they can be very volatile and they can snap, in a very, very short moments of short notice, and in a moment's notice, like, it can drop very quickly. And that's why I would urge caution for SanDisk. Yes, it's like a really hot stock right now, but we've been through this before. We've gone through these cycles before. I mean, Palantir has gone through this. NVIDIA has gone through this. Tesla has gone through this. All these stocks have gone parabolic only to have stabilization and then eventually come down and drop like 20, 30, 40, 50%. More recently, we experienced it with iron. We looked at BMNR. A lot of these companies went up parabolic and they came back down. So I think it's really important to be very, very careful with these. Okay, Manchester United in shambles. Yes, it is with the new management. I mean, we don't even know, I think, who's going to be the new manager at Man United. So I know that is a different story altogether. But let's see. So Copart we covered, WDC we covered. Can you please look at Oscar for support resistance levels? Yes. Everyone, just do me a favor though, share this live stream if you haven't already and drop a like. I would really appreciate that. Helps out the channel tremendously. As more and more people can join us, we can have a more engaged, lively discussion, higher quality discussion for new ideas, new stocks that we can look into together. And I'm going to be restarting individual stock analysis very, very soon. So we'll be utilizing the full power of the MoneyVest platform, underwriting a lot of individual stocks, looking at what we can assume for growth rates, PE multiples, what is fair valuation, and going over both the qualitative analysis as well as quantitative analysis to better understand the business as well as the fundamentals, and then figure out the next big winners for 2026 and beyond. So stay tuned for that because I'm very excited to get started with some individual stock analysis again. Deeper dives, 20, 25-minute videos, longer videos going over individual stocks, one stock at a time, and spending time on it. So please drop a like and share this so we can have more engagement from everyone. So Oscar, again, continues to consolidate sideways. We're seeing some nice momentum pre-market on the hopes that there's going to be a deal soon on the ACA approvals. Resistance all the way back up to $23, $24. So that is a quadruple resistance where Oscar continues to get rejected at, and support level is going to stay put inside this green rectangle. So this has really been a range bound stock for a really long time. So we got a resistance all the way up here and a support level all the way down here, and it's a trader's paradise right now. Okay, do you mind sharing your current cover call positions and explaining why you chose those positions? So I do have Meta covered call, which is going to be expiring on Friday, and I believe it's going to be up like 70 or 80% today as soon as the market opens. But then I have Nvidia covered calls, I have SoFi covered calls, I have Tesla covered calls, and really the idea has been to collect a lot of premium while also capturing as much upside as possible. And there's not much to it. That's really it in a nutshell. And that is what my plan was. So yeah, I mean, that is going to be the breakdown. And of course, we can go over individual stocks and what the reasoning and the thesis was. But the bottom line is, when I am selling a covered call, strike selection, very, very important. I have to absolutely make sure that I'm comfortable selling that stock at that strike. Because if I'm not, then I would pick a different strike. And if I do get into a comfortable situation, then the plan is to simply roll out those options farther. So rolling up and out in order to capitalize on more potential upside while also collecting a net credit. And one of the most important things for when you are rolling options is to keep track of your debits and credits. It's very important because what ends up happening is that if you don't have a good idea of what your debits and credits look like, then you can get into trouble, right? Because then you won't even realize, but you might end up realizing a loss. So the best way to do this is to simply come over to a notepad on your phone or on a spreadsheet, because your brokerage is not going to do that for you. Your brokerage is not going to keep track of how much you're collecting and how much you're giving back when you're rolling options. So you have to do that manually. It's a little bit of a task, but it is super helpful. And all it is you have to look at credit, debit. You can just put that in. So if you collect, let's say $500 for selling a call, and then you buy it back for, let's say, $900. So obviously you're going to be losing $400 there, but when you're rolling, you're simultaneously opening a new option. And let's say that you do that for $1,100, because always doing it for a net credit. So your total premiums collected for that entire trade is $700, right? Not $1,100, not $500. You didn't lose $900. You collected $700 for the entire trade. Granted, if this position right here, the final call that you've sold, you don't roll it, you don't close it, you let it expire all the way through, whether that expires in the money, out of the money, the bottom line is that you collect 100% of this last call that you've sold. That's when the entire calculation comes in. And there's also a way to calculate what is the break even for that trade, because if you do the math, you lost $400 here, and then you need to capture at least $400 of the premium for this $1,100 contract. So the way to do that, obviously 400 divided by 1,100, so that's 36%. If you've captured 36%, then you're break even on that trade. Anything over that is your profit. And that is very, very important math because I highly recommend this for everyone who is trading options, rolling options, selling options, to make sure that you track your debits and credits. Okay, thank you for the TA. Did you cover SoFi? Not yet, but let's take a quick look on SoFi as well. A lot of consolidation sideways, resistance all the way up to $30. I do think that the moment it breaks above 32 or 33, I think SoFi is not going to take a lot of time getting up to $40. I think it's really that huge resistance that's holding us down somewhere between 30 and 32.50. But the moment it cracks above that level, that would be the next big wave for SoFi, because for the longest time, we were kind of holding below $18 to $20. That was kind of like the ceiling for SoFi for a good 4 years. And then it finally broke above it in June of last year. And then it quickly rallied 70% to $30. It took us like 6 weeks, 8 weeks, 2 months to get from 20 to 30. That was a 50 to 70% gain from 18 to 30. And it took us 4 years breaking out above that ceiling. And I think Obviously, I can't say if it's going to take us another 4 years staying below 30, but the moment it breaks above 32, 33, I think the momentum will be rather quick on that volume breakout, because right now you can see the weekly candles. There's a lot of consolidation sideways. I mean, it's just been, whipping back and forth between that range of 25 to 30. Longer wicks, there's a lot of indecision. I think the buyers and sellers are both very strong. The buyers don't want it to go below 24, and the sellers want to keep it below 30. And I think that as a result, we're kind of seeing week after week a little bit of a battle between the buyers and the sellers. And it just ends up going nowhere, every week. So as a result, if the bullish buyers of the bulls can actually pull through and push it through over 3250 on some decent volume, then I think all that supply gets absorbed and, we see 40 easy. But until then, I think it's going to be a bit of a challenge. So APLD we covered earlier in quite detail. Actually, we went over the earnings, revenue, forecasting, valuation multiples, everything. So please, rewind, go back, watch that update, and you can tune back in to the live stream. But yes, we covered APLD earlier. Okay, let's take a look at Amazon very quickly. So Amazon finally getting a lot of momentum. We were having that discussion in our Discord, and even during the live stream, a lot of people asking about Amazon, the sleeping giant. Is it finally going to wake up? And year to date, it actually seems to be performing better than some of the other Magnificent 7 stocks. If you come over to Max 7 watch list, I think Amazon might be the best performing Max 7 stock right now. Yes, Amazon is 4.4%. Finally starting to wake up. 4.4% year to date, even better than Ethereum, gold, silver, Bitcoin. It is actually the best performing at the moment. And we've only just started. So what happens this time next year, of course, we'll find out. But so far, so good. Amazon continues to be on my high conviction list. I think it's a phenomenal business over the long term with economies of scale, with its large network, logistics network, and what they've built. It's not very easy to replicate. They have a very strong defensible moat that only they can actually monetize really well over the long term. So if they start to prioritize their bottom line and earnings, margins expansion with multiple expansion, I mean, Amazon is finally very, very profitable now. I mean, 7%, 5.5%, and 9% margins in 2024. If he can push this up double digits, 15 to 20% over the long term with AWS tailwinds, then I think Amazon's easily a $3 to $4 trillion business. 2.5 trillion right now, so 4 trillion, 4.5 long term, possibly even 5 trillion. Again, 5 to 7 years out. Okay, your thoughts on Chevron or USL? So energy companies, as mentioned before, they are very cyclical. They're going to be very volatile. This is not an area where you go for growth. This is not an area where you go for a significant appreciation, but this is an area where you go for stability, for value, for dividends. So it really will cater to very different kinds of investors. So if you're somebody who's looking for an energy play with some decent dividends, because Chevron does pay out pretty hefty dividends of 4.4%. I was just watching a video the other day where had you just put in, I think $100 a week into BP over the last 30 years, you would have collected, over $120,000, $150,000 in dividends alone in the last 30 years. And that's the power of dividend investing over longer time frames. So you can either prioritize income, or you can prioritize growth, or you can prioritize a blend of both. And if your goal is pure appreciation, I want to grow my capital, maximize appreciation as much as possible, then Chevron, Exxon, BP are not going to get you there. Palantir, Nvidia, Tesla might just get you there. But if your goal is like, I want to have something more stable and I want to collect monthly checks and income and dividends, then yes, that's where you go to find REITs, energy companies, utility companies, value stocks, or even physical real estate. So that's where the discussion is different. But if you want a blend of both, then there's a different kind of stocks, kind of sectors you can look at. So Chevron, Exxon, U.S. oil giants, they're going to be around for a long time. Dividend yield is strong, consolidating sideways, and it's been consolidating since 2022. So you've got 4 years of consolidation. Resistance, getting rejected at 165 again. Support level 154 down to 127 once again. Same thing with United States 12-month oil fund. Doesn't look like it's got any dividend, low volume. I would actually avoid this because it's got no volume, USL. Why is NVIDIA dropping? Let's take a look. Is NVIDIA dropping right now? No, it's not. It's 11 basis points higher. It's 189 right now. It's not dropping at all. So we also have to characterize what is a drop, right? What is considered as a sell-off. I think it's really important. I think it has to be standardized. I honestly feel that every person as a market participant should know what words we can use to characterize a specific drop and or a rally. And so the way I look at it, and something that we have on our website as well, is very simple. If a stock or an index, let me just ask you guys, all right? We'll just do a very quick survey. If a stock or an index is between 0 and 5% of all-time highs, what do we call that? What do we call when a stock or an index is down between 0 and 5% from all-time highs? So if a stock is down 2% from all-time highs, or 3% or 4%, up until a 5%, what do we call it from all-time highs? Let me see. And I want more participation. I want more and more people to participate. Okay, so we call that a dip. Temoff is saying a pullback. David is saying a pullback. Really? I'm surprised. Mark says dip. So that is indeed, unfortunately, Temoff and Dave, it's a dip. So we call that a dip because it's a very small dip. It's well within the structure of the overall trend, higher highs, higher lows. It would, in many circumstances, be considered as a higher low, right? So you're still moving up on a nice uptrend, and it's a 5%, 4%, 3% dip. If it's more than 5% but less than 10%, so 5 to 10%, then what do we call it? If it breaches that 5% level and it's now well within 10% of all-time highs, and it's down anywhere from, let's say, 6, 7, 8, 9, up till 10%, what do we call that? English is not my first language. You're literally a teacher. You are a teacher. Yes, so pullback. Pullback is indeed the correct answer there. If we are down anywhere from 5 to as much as 10% from all-time highs, we characterize it as a pullback. And again, I don't think there's like a manual for this, or this is like standardized, but at least that's how I view it, and that's how I've understood the markets for a very long time. If it's more than 10%, I think now we're getting into the territory where it is indeed characterized as those names. So if we're down more than 10 but less than 20, what do we call it for a stock or an index? What comes next if we're down over 10% but less than 20% from all-time highs? Doesn't matter what it is, a stock or an index or crypto or commodity. If it's down 11, 12, 13, 14% from all-time highs, all the way till 20% from all-time highs, what do we call that? Let's see. Temoff is going to say pullback for all of them. He's going to be right at least on one of them, right? It calls cash is ready. Well, you better be deploying at that point. Cash needs to be ready during a dip, not during a, which comes next is a correction. Yes, it's a correction if we're down over 10% from all-time highs, but less than 20%. And then if it's more than 20% for any stock or index or ETF, what do we call that? So yes, all you guys are correct. It is called a correction. So what do we call if we're down more than 20%? If we're down more than 20 but less than 50%, let's say, from all-time highs for individual stocks, again, index ETFs, index funds, all that. Bear market, perfect. That is indeed a bear market. That would be considered and classified as a bear market officially for a stock or an index or an ETF. S&P 500 goes down over 20%. It's officially in a bear market. And if it's down over the big one, the 50% mark, which we haven't seen, at least we haven't seen, right? I mean, since we've been doing it over the last 5 years, I haven't seen the S&P 500 or the NASDAQ go down over 50%. I think the last time S&P 500 witnessed over a 50% drop was back in 2008. So if you come over to the monthly time frame, we're kind of fortunate in that way and unfortunate in that way because that's where the best deals happen. But this was the last time the S&P 500 witnessed over a 50% blank in the market, which is what? Calls doomsday, get out. Now that is a full-blown crash at that point. So again, the hierarchy is dip, pullback, correction, bear market, and then a full-blown crash, or Christmas as we like to call it, or Santa is here. We've got deals, discount. You can also call it Buffett's dream. Yes, all of those are correct. Call it a recession, but that is what it is. And we haven't seen that obviously since 2008. And depending on how aggressive you are with investing, you can either call that as a fortunate or as an unfortunate event. Do we have any words while it's going up? I mean, if it's going up, we're almost at all-time highs. We're rallying, we're ripping, face ripper rally, you can call it. So, but no, it's mostly for on the way down, because you can calibrate it from all-time highs and how much are we down from all-time highs. You can actually do that on our platform as well. So, by the way, all these stocks will already have their statuses over here, whether we're in a dip, pullback, correction, bear market, crash, all that for indices as well as individual stocks. But then we also have the bear market analysis for S&P 500 specifically. It actually shows you how many times in the past the S&P has actually gone into a bear market. So over here, this is one of my favorite charts because it shows you how far away we are from all-time highs. If I go over 3 years, you can see that dotted line is the all-time high. And right now we are January 7th, 0.34% down from all-time highs. And when this number goes down all the way here, this was back in April, down almost 19%, which is the closing value. But in reality, at one point we were down over 20% from all-time highs. But this essentially tells you how far away we are from all-time highs. And you can look at it from a 5-year perspective. You can see this was the last bear market back in 2022, down over 25% from all-time highs, 7 years, and then 10 years, and then of course the maximum as well, which will show you the two big crashes in 2009 and then during the dot-com bubble as well. So I like this chart visualizing, and then all this is also available for individual stocks as well. So I think that's pretty cool. Anyway, so market's about to open now in about a few seconds here. Let's take a look at what my meta calls are going to be doing. And I'm going to be closing them out today, given that they are going to be up quite a bit as meta continues to drop. So we are indeed open in this market right now. Nvidia is flat. Tesla slightly down, close to 1%. You got SPY, QQQs, everything is very, very flat right now. My meta calls up 84%. I think it's time to ring the register. I love this. I honestly love this. It's been amazing trading meta. Very, very amazing to say the least. And it's incredible. Absolutely incredible. Let's see if I get filled. If I do, that would be amazing. And unfortunately, a lot of our members, in fact, want meta to go up, which is fair, but it hasn't given us any inclination that it's going to. So it is done. It is done. Meta covered calls closed for 90% profit because buy to close limit at 59. Done. Dunzo. Not $71, but $59. That's where it got filled. And let's see what Meta does next. 640. I could have actually held them until Friday, until tomorrow. Collect another $40, $50, but I'm going to sell a new one. If I can catch a nice rip intraday, I'm going to sell like a 650 now. I'll lower my strike. All right, everyone. Thank you so much for joining. Markets are indeed open. Appreciate you all. And we'll be back at it tomorrow, a little bit earlier tomorrow because of the unemployment numbers. And once again, thank you so much for joining. Link's going to be down below if you're interested in being a part of our MoneyVest community. Happy investing. I'll see you all in the next